Hello everyone, I'm Asian Guy. Over the last decade, something unusual has been happening across the most advanced economies in the world. Output keeps rising on paper, technology keeps improving, markets keep trading, yet the engine underneath it all, productivity, has been slowing down quietly, persistently, and across borders. This isn't a recession story, it isn't a crisis headline. It's a structural shift that shows up in places most people don't look at, because nothing appears broken in the moment it's happening. But this shift matters far beyond growth statistics or academic debates. Productivity is the mechanism that allows societies to absorb debt, sustain wages, fund institutions, and maintain social stability without constant conflict over resources. When productivity slows, systems don't fail immediately, they strain. And what makes this moment different is that institutions appear to be adjusting to this reality already, subtly, incrementally, without public acknowledgement. Capital allocation is changing, policy tolerance is shifting, risk is being redefined. This isn't about panic, it's about recognition. Because when productivity declines slowly enough, most people assume it's temporary. But history shows that when it becomes structural, the consequences unfold over decades, not quarters. Before we go further, subscribe right now because what you're about to hear explains a shift most investors still haven't noticed. Let me walk you through the numbers. When economists talk about productivity, they're usually referring to output per hour worked. It's a deceptively simple measure. Over the long term, it's the single most important driver of real wage growth, corporate profitability, and fiscal sustainability. In the decades after World War II, advanced economies experienced sustained productivity gains driven by industrialization, infrastructure build-out, demographic expansion, and technological diffusion. Those gains allowed living standards to rise even as populations grew and welfare states expanded. But if you look closely at productivity data from the early 2000s onward, something changed. Growth slowed, then it stalled, and in some cases, it reversed. In the United States, productivity growth averaged more than 2% annually for much of the post-war period. Since the early 2000s, that number has struggled to reach half of that. Europe followed a similar trajectory with even weaker outcomes in countries that once relied heavily on manufacturing efficiency and export competitiveness. Japan experienced this slowdown earlier, which is why it often serves as a preview rather than an outlier. The common explanation offered is cyclical weakness or measurement error, but cycles recover. Measurement errors don't persist across decades and continents. What we're observing instead is a regime change. Now notice what quietly changed beneath those averages. The composition of economic activity shifted toward services, financial intermediation, and asset management, sectors where productivity gains are harder to generate and harder to measure. At the same time, capital expenditure as a share of GDP declined. Companies increasingly favored share buybacks, mergers, and balance sheet optimization over long-term investment in productive capacity. This wasn't irrational behavior, it was incentive-driven. When demand growth is uncertain and labor is aging, the return on physical investment becomes less attractive. So firms optimize for financial efficiency rather than productive expansion. Look closely at participation quality in the labor market. Headline employment numbers often look strong, but hours worked per capita have stagnated. Labor force participation among prime age workers recovered unevenly after each downturn. Older workers stayed longer out of necessity. Younger workers entered later, burdened by education costs and weaker early career opportunities. Productivity depends not just on employment, but on how effectively labor is combined with capital and technology. That combination has been weakening. This pattern doesn't appear often. We've seen it before, but only during stress periods, typically following major structural disruptions like wars, demographic collapses, or prolonged misallocation of capital. In the 1970s, productivity slowed as inflation, energy shocks, and policy uncertainty distorted incentives. In the interwar period, productivity gains were uneven and fragile, undermined by debt overhangs and institutional breakdowns. What's different now is that the slowdown is happening alongside rapid technological progress. That contradiction should raise questions. But this is where it becomes important. Technology alone does not guarantee productivity growth. It has to be diffused, integrated, and scaled across the economy. Over the last 20 years, technological gains have been increasingly concentrated in a narrow set of firms and sectors. Large platform companies achieved enormous efficiency internally, but their gains did not translate proportionally into economy-wide productivity. Smaller firms struggled to adopt new technologies due to cost, complexity, and regulatory burden. The result was a widening gap between frontier firms and the rest of the economy. Aggregate productivity suffered. Now consider capital flows. Institutional investors, pension funds, and sovereign entities have gradually shifted allocations away from long-term productive investment toward assets that offer liquidity, stability, or policy protection. Infrastructure spending became politicized and delayed. Venture investment became more concentrated and more speculative. Manufacturing investment moved offshore or was deferred altogether. These decisions weren't coordinated, but they were rational responses to a world where long-term growth appeared less certain. Passive allocation favored scale over innovation, incumbency over experimentation. This reinforced the dominance of large firms and reduced competitive pressure. Over time, reduced competition leads to lower productivity growth. It's a slow feedback loop, but a powerful one. Now look at industrial demand tied to energy, technology, and defense. Energy transitions require massive upfront investment with uncertain returns. Advanced manufacturing requires skilled labor that is increasingly scarce. Defense spending has risen, but it prioritizes security over efficiency. These sectors absorb capital and labor without necessarily increasing civilian productivity. Again, this is not a failure, it's a trade-off. But the aggregate effect matters. Supply-side rigidity compounds the issue. Aging infrastructure, zoning constraints, regulatory complexity, and demographic decline all limit the economy's ability to respond to demand. When supply can't expand efficiently, growth relies on leverage and price increases rather than output gains. That's where productivity quietly erodes. Now consider the relationship with currency confidence and real yields. Productivity growth underpins a currency's long-term purchasing power. When productivity slows, maintaining growth requires either higher debt or looser policy. Over time, this strains credibility. Real yields become distorted, not because markets are irrational, but because they're adjusting to lower sustainable growth. Interest rate expectations become less about controlling inflation and more about preventing instability. We've seen this before. In periods of declining productivity, policymakers face narrowing choices. Structural reform is politically difficult. Fiscal expansion risks debt accumulation. Monetary accommodation risks asset inflation. Institutions adapt by managing appearances rather than addressing causes. That's when trust begins to erode, not suddenly, but incrementally. Look closely at historical parallels. Late-stage Roman economies experienced productivity stagnation as land ownership concentrated and incentives weakened. Early modern Spain struggled with declining productivity despite access to vast resources. More recently, Japan's experience shows how productivity slowdowns can coexist with technological sophistication and social stability at the cost of long-term dynamism. These are not collapses, they are slow recalibrations. Now notice what quietly changed in corporate behavior. Profit margins remained high even as productivity slowed. This was possible because firms gained pricing power, financialized operations, and globalized supply chains. But pricing power is not productivity, it's redistribution. Over time, redistribution without growth creates tension between labor and capital, between regions, between generations. Investor psychology adapts to this environment. Expectations lower, time horizons shorten, risk tolerance shifts from expansion to preservation. Institutions don't announce this change. They implement it through portfolio construction, governance standards, and policy frameworks. That's why the decline in productivity matters beyond economics. It reshapes how societies allocate trust. At this point, the evidence is not dramatic. That's the point. Productivity doesn't collapse, it fades. And when it does, the consequences are structural. Growth becomes harder to achieve, debt becomes harder to service, policy becomes reactive, institutions focus on stability rather than progress. This is the environment advanced economies are now navigating. Not crisis, not boom, but constraint. And constraints accumulate. Now let's shift from evidence to interpretation, because this is where the slowdown in productivity stops being an abstract macroeconomic concept and starts to explain the behavior we're seeing across markets, institutions, and policy frameworks. When productivity weakens, inflation stops being purely a price phenomenon and becomes a credibility issue. In a high productivity environment, inflation can be absorbed. Wages rise alongside output. Efficiency gains offset higher costs. Monetary tightening restores balance without destabilizing the system. But in a low productivity environment, inflation behaves differently. Price increases no longer reflect temporary imbalances between supply and demand. They reflect structural constraints. The economy simply cannot produce more efficiently at scale, so prices adjust instead. This is why inflation over the last several years has been so difficult to manage without collateral damage. Policymakers treated it as cyclical. Markets treated it as transitory. But underneath, productivity had already weakened the system's ability to normalize. Tightening policy slows demand, but it doesn't restore productive capacity. It suppresses symptoms while leaving causes intact. Look closely at real yields. In theory, real yields represent compensation for growth and inflation expectations. In practice, they become a signal of credibility stress. When productivity is strong, real yields can rise without destabilizing debt markets. When productivity is weak, higher real yields threaten solvency, public and private. That's why rate expectations have become volatile and reactive. Markets aren't debating inflation alone. They're debating how much strain the system can tolerate before something breaks. Now notice how institutions respond under these conditions. They don't position for growth. They position for resilience. Pension funds extend duration. Insurers prioritize capital preservation. Sovereign entities diversify reserves. None of this requires a public declaration that productivity has stalled. It's embedded in behavior. Currency trust erodes the same way, not through collapse, but through fatigue. When productivity slows, currencies rely more heavily on policy credibility rather than economic dynamism. Over time, every intervention carries diminishing returns. Each round of stimulus stabilizes less. Each tightening cycle risks more damage. Markets internalize this reality long before official narratives change. This is where investor psychology shifts. In high growth eras, investors tolerate volatility because progress feels inevitable. In low productivity eras, volatility feels dangerous because there's no confidence in recovery speed. Risk premiums rise quietly. Valuations compress unevenly. Capital flows favor assets and structures perceived as insulated from long-term stagnation rather than exposed to it. But this is not pessimism. It's adaptation. And adaptation is rational. We've seen this behavior repeatedly during periods of slow institutional erosion. In the late 19th century, European empires experienced productivity plateaus as capital misallocation and demographic pressures mounted. Financial systems became conservative. Political systems became rigid. Growth didn't stop, but it lost momentum. The system became brittle. Japan's experience offers a modern parallel. Productivity growth slowed. Demographics turned unfavorable. Institutions prioritized stability over disruption. Markets adjusted accordingly. This wasn't failure. It was acceptance of constraint. Advanced economies today are moving through a similar phase, but with a crucial difference. They are far more leveraged, financially complex, and globally interconnected. That amplifies the consequences of slow productivity decline. Now let's talk about policy fatigue. Structural reforms that could improve productivity education overhaul, regulatory simplification, infrastructure investment, demographic support, are politically costly and slow to deliver results. Monetary policy is faster. Fiscal policy is more visible. So institutions lean on tools that manage demand rather than improve supply. Over time, this imbalance compounds. Each cycle leaves more debt. Each intervention distorts incentives slightly further. None of these decisions are reckless in isolation. Collectively, they reduce long-term productivity potential. This is why institutional trust erodes without a crisis. People sense that systems are working harder to stand still. That effort shows up as longer working hours with stagnant wages, rising asset prices without corresponding income growth, and increasing dependence on policy support. Confidence weakens not because institutions fail outright, but because they feel less effective. Markets reflect this tension. Equity markets favor scale and defensiveness. Credit markets price stability over expansion. Capital formation slows. Innovation becomes incremental rather than transformative. These are not moral judgments. They are observable outcomes of a constrained productivity environment. Now let's resolve the full argument. The slow decline of productivity in advanced economies is not a temporary anomaly. It's a structural condition shaped by demographics, incentives, capital allocation, and institutional design. It doesn't announce itself with crashes or headlines. It reveals itself through persistent underperformance relative to expectations. This decline changes the role of markets within the financial system. Markets become less about allocating capital toward future growth and more about managing risk within existing structures. Asset prices reflect durability rather than dynamism. Policy becomes defensive. Institutions focus on preserving legitimacy rather than expanding capacity. Long-term implications follow naturally. Growth becomes episodic rather than sustained. Inequality becomes harder to address without productivity gains. Debt becomes a permanent feature rather than a transitional tool. Political pressure increases as distribution replaces expansion as the primary economic mechanism. None of this implies imminent collapse. Systems can operate under constraint for a very long time, but they operate differently, and understanding that difference matters. Awareness changes behavior, it changes expectations, it reduces surprise, and it allows observers to interpret market signals not as noise, but as adaptation. This is not about forecasting outcomes, it's about recognizing structure. Thanks for watching, subscribe, share this, and stay alert. Because what's happening right now matters more than most people realize.